January 19th. I so want to fall into the pit of the shutdown, and I'm not going to. Historically, these shutdowns go back to Newt Gingrich's elegant suicide 20 years ago, and even before. Historically, markets don't care about them. Markets don't care about them. We don't care about them. The entertainment value, those of you who have seen Blazing Saddles might consider a Mel Brooks movie in which progressively during the movie everybody in it takes somebody hostage, and the hostage takers are taken hostage, and finally everybody's a hostage of somebody, and groups are arguing about who's hostage. In any event, pay no attention to that. The important thing is the Fed, and I hate to say it, but rates are up. They're going up more, and from the perspective of the last several years, they're going up quickly. We spent last year within 0.1% of 4 all year long. We may be 4.5 by the end of the month. And the story is weird. I mean, aren't they all? But this one is in particular weird. We still do not have present-day inflation. The Fed began to raise its interest rate 2 years ago, as it said, to normalize, to get off of zero, to rise to something above zero, to avoid the distortions that could come from zero. At some point, as the Fed keeps going, if it keeps going, its rationale changes to preempting, meaning the economy is growing so far above its capacity to grow without inflation that the Fed goes beyond normalizing to leaning against the economy. And it hasn't yet, but it's about to. The wigwags from people at the Fed, the consensus forecast at the Fed is 3 hikes this year, 3/4 point hikes. The Fed has gone from 0 to 1.5 in 2 years. It expects to go up 0.75% during the year this year. The wigwag from them in the know says that that's maybe low side, that they may come 4 times. And there's no law that says that they can't do a hike that's more than 1/4 point. Now, what's on their minds is the prospect of inflation, the gasoline-soaked kindling for inflation lying all around us. Secondly, the tax bill, and the tax bill's interaction with the stock market, and the stock market's interaction with the economy. The stock market is enough to make anybody at the Fed nervous about too much money lying around. The tax bill, nobody can really quantify the economic effect that it has until it has the effect, but it certainly had an electrifying effect on the stock market that was already in what Alan Greenspan would have called irrational exuberance. And for all of those reasons, here comes the Fed. Now, here's the good news. Long-term rates in a normal economic recovery rocket upwards at the very first Fed move, trying to anticipate where the Fed's going 2 or 3 years hence. The Fed's been hiking now for 2 years, and long-term rates really haven't moved at all. Now they're going to. They're not going to move so much in a rocket anticipating probable inflation and a much higher Fed. Long-term rates are going to move sort of by bulldozer. That is, as the Fed pushes at short-term rates, long-term rates are going to be forced higher. Not because they want to go there or think they should go higher, but the Fed controls the overnight cost of money, presently 1.5. 10-year T-note has been 2.4 for a year or more. If the Fed winds up above 2, at 2.25, there's no way in the world to justify owning a 10-year bond paying 2.40. It's as the Fed comes up from underneath long-term interest rates, it's going to push them higher. My suspicion is, as long as inflation stays under control, long-term rates, to include mortgages, will rise perhaps half as fast as the Fed. Cling to that in the foam out here, which would put us at some point during the year maybe approaching 5. The change in psychology just in the last week, we've gone from 240 in the last week to 268 We've taken out all of the technical support. There isn't any at all. There's nothing until 3% on 10-year, which would mean mortgage rates at 4 3/4 or so. The perception is that the economy has picked up speed, and the stock market, I mean, everybody's 401k envelope each month looks like a slot machine. I mean, you open the thing and every month it has 3 cherries in it. And people do crazy things when they feel as though their wealth is rising both in stock market investments as well as their homes. So here we go. So long as inflation stays under control, we're going to be okay. If inflation itself comes out of the box, rises to 2 or beyond, then back to the bunkers. But that's for another day. Thank you.